Varun Goel joins in, Senior Fund Manager Equity at Mirae Asset Investment Managers on the show right now. Varun, hi, good afternoon. Good to have you on the show. Varun, how is it that you're assessing the market construct right now with so many moving parts at play? The US equity market correction just about begun. You're seeing that reversal in the dollar as well, which typically has never been the case because, you know, in a risk-averse scenario, you actually see the dollar hold up, but that's not really the case right now. And then, of course, you know, emerging markets are a bit of a divided construct as well, if you will.
Good afternoon, Aisha. Thanks so much for having me on the show. I think as far as Indian markets are concerned, I think that there was a cyclical slowdown which has been playing out for the last 6 to 9 months, and it appears to us that growth is incrementally going to get better. I think the three large reasons. One, of course, the significant monetary tightening that we saw in the last 12 to 18 months has ended. We've seen a rate cut already, and our sense is there might be one or two more rate cuts during the course of this year. And significant restrictions, which were imposed by RBI have also been eased off. Second, of course, there has been a large tax cut announced in the union budget. And third, I think there has been a fairly good Rabi crop, and I think the farmers will start getting money in their hands in the month of March and April. So because of all these factors, we believe that the growth will start bouncing up from April, May onwards. And I think Nifty earnings, which had come down to low single digit in the last financial year, which is FY25, should start going back to that 10-12%, which is the 30-year average. And hopefully the markets would also converge in that direction.
All right, so that's the broader take on the markets. But Varun, also help us understand at this market, what is the theme that you like at this point in time and what is that you don't like currently?
Well, I think the lending space definitely looks attractive, both banks and NBFCs. As I said, we are expecting rate cuts and significant monetary easing this year. I think credit growth should also bounce back. Finally, the deposit growths have kind of caught up with the credit growth rates, and I think that will ease off the pressure as far as NIMs are concerned for both banks and NBFCs. Second, I think export-oriented sectors, be it IT and pharma, should do well. There has been a significant depreciation in the rupee, which will definitely boost the margins of a lot of these exporting companies. I think discretionary consumption, as far as your low-ticket discretionary items in India are concerned, that should also show good bounce back as the benefit of tax cuts start showing the impact. So I think there are a lot of sectors which should see good earnings growth coming back in FY26, and we are selectively participating in those spaces.
Understand what specifically are you penciling in for the Indian IT space, because like you briefly touched upon the rupee, but that is seen to be reversing a bit. Give us some sense also, where do you see rupee headed? And along globally, Varun, what we are seeing is that the global IT companies are seen to be a bit under pressure. A rub-off impact could definitely come into the Indian IT players. So help us understand that what's making you bullish on this theme.
I think broadly, if you look at the North American banking BFSI space, which contributes about 1/3 of Indian IT companies' revenues, has been doing quite well, while last year was fairly muted for them. I think this year onwards, we have seen a more positive commentary, larger deals coming in. Of course, in the short term, there might be some noise about a slowdown in growth, and various news flow related to tariffs. But I think broadly, we have seen more outsourcing activities as far as the insurance, mortgage, and banking sector in US is concerned, which will definitely help Indian IT companies. I think overall, as we see the transition, a lot of more use of AI technology, I think a lot of Indian IT companies will participate in that growth story in their own unique way. And as such, we remain positive both on the revenue growth side as well as on the margin side. As far as rupee depreciation is concerned, I think we have seen a fairly sharp rupee depreciation after almost 2 years of stability in rupee. And our sense is we are unlikely to see rupee going back to the levels it was in the last calendar year. So I think some of this rupee depreciation will sustain, and IT companies might be able to to squeeze off some margin benefits from that going forward.
Varun, I just want to get back to the point that you were making on financials and banks and NBFCs. Would you make any distinction between either corporate lenders, the private sector enterprises, or for that matter, the PSBs, and what to do with MFIs? Does it seem like that segment could have bottomed out?
Yeah, so I think while the retail lending segment continues to do quite well, and I think the growth there will sustain, we're also seeing, so as some curves have been eased off on the personal loan, the credit card side, that segment should also see revival in growth. I think mortgages continues to be one of the very large spaces which continues to do, mid double digit kind of growth rates, which should sustain. And I think the SME sector continues to do well. So again, we don't see any sign of credit problems in some of these sectors. I think corporate lending is something which was very slow, I think in high single digit for the last financial year. And that is where we would expect some growth uptick to happen as more and more private capex happens during the course of the next 12 to 18 months. So broadly, I think most segments of the banking space look decently fine in terms of both growth rate and asset quality. I think MFI has been through a downturn. I think we still may take 1 to 2 quarters before the pain there goes away completely. But I think the worst might have been seen in terms of delinquencies and NPS, and incrementally things may start getting better, although full recovery may be 1 to 2 quarters away.
All right, that's the take on financials. But today, of course, one such sector that is making a strong comeback is Nifty Realty. What we see on the index front, it's a 4% jump. And a lot of these stocks are participating, like DLF and even Macrotech developers. And specifically on that, on Macrotech developers, that is Lodha, there was a news flow that the company is and has actually signed a deal of 280 crore rupees land parcel acquisition in Mumbai. And on that, just a while back, we had the clarification also coming in where the company does say that evaluating such deals is a normal course of business. But yes, the said land parcel appearing in media is one amongst such land parcels which is under discussion. So a bit of a confirmation there. But Kunal, what do you make of Nifty Realty as well as specifically on Macrotech developers? What's your take? Because the stock is not leaving that 1100 odd rupees mark and not breaching that.
Yeah, so I think on the specific on the stock specific front for Macrotech developers, the stock, yes, over the last few weeks has been protecting this level of 1100 to 1000. In fact, over the last 1.5 odd year, we've seen multiple retests below that 1100 mark, but then broadly the stock holds on to those levels, and we've seen a bounce back happening for the stock price. So we can just expect that maybe this time around it could be very similar for the stock in terms of a potential bounce back. Now for Nifty Realty Index, now this could be an interesting case because till yesterday we were at a point where the Nifty Realty Index was almost at a 20% divergence from its longer term averages. And I think around the 800 mark for the Nifty Realty Index, that was also a double bottom test for the index on the short term charts. So if there's a bounce back, which we are seeing today, the bounce back should see a further leg on the upside. We could be looking at 840 to 860 kind of a levels for the Nifty Realty Index, which means potentially another 3 to 5% swing on the upside is what we can expect for the index. So broadly 5% plus is where I would expect for many individual components. The two names specifically which are looking attractive over the last 3-4 days of the charts which I've tracked, one of them is Kolte Patil from the mid cap end, and the other is DLF, which is starting to show signs of a bullish engulfing on the daily charts.
Varun, how is it that you are positioned right now when it comes to the realty pack? It's been thrashed out in the recent market correction for sure. And many are talking about as to how maybe from those COVID lows, the realty market may have actually peaked out in select few pockets. And this at a time when pretty much every regional player is becoming very aggressive in trying to become pan-India. How do you think the sector dynamics are positioned right now?
Well, I would remain extremely positive on the residential real estate space. I think the last time the cycle peaked out in 2012-13, the EMI to take home salary ratio had gone up as high as 46-47%, and that really indicates poor affordability. If we look at the pan-India numbers today, we are nowhere near that. I think we are more like 36-37% on a pan-India basis. Yes, there might be some pockets of froth, but broadly, I think the residential real estate space remains attractive. In this cycle, we see much better regulation post-RERA. We also see there's a lot more end-user demand. While there are pockets where investors are dominant, but I think largely the demand has been led by the end user. And we believe 4-5% kind of pricing growth, 6-7% volume growth, can lead to 10 to 15% kind of top-line growth for most developers. And as such, we remain quite constructive on the space.
All right, remain constructive on the realty pack as a whole. But what we are seeing today is a good jump in some of these beaten down names like Trent as well as Zomato. I beg your pardon, Paytm. Just wanted to get a sense on charts, Naresh, between Paytm as well as Trent. I know that they are very different sectors, but both of the names are beaten down names. Give us some sense that where do you see the stock headed, and what do you make out of this strong move that we are witnessing today?
So Paytm has seen a decent correction, good 30-35% taken out from the top. And today, finally, after so many days of correction, as we've seen the first reversal signal. And if we sustain above the 700, 720 mark, that indicates a short-term bottom is in place. And it could go towards the 800 mark. Trend, on the other hand, has been a phenomenal mover over the last 2 years. Top is in place. We've started making higher lower tops and lower bottoms. For now, any recovery needs first a recovery above 5,300 odd levels, which was the recent high. Till that point of time, the trend still remains weak.
Okay. That's, of course, the take coming in right now on which way some of these consumption plays, so to speak, are moving. But Varun, how is it that you're positioned right now on consumption and ex-staples? We'll talk about staples in just a bit. But, everything from hospitality to aviation to even apparel, etc.
The travel and tourism remains one of the most attractive pockets as far as the discretionary consumption is concerned. I think hotels continue to be in a scenario where supply is going to be tight, at least for the next 2 to 3 years. So I think the room rentals will remain strong. I think travel, again, airlines should continue to do well because the yields seem to be fairly attractive. And when you combine that with the cooling of crude oil price, which looks like crude will be softer this year, I think that is an added benefit. So I think that's something that we are seeing increased propensity by middle class India to consume on travel, tourism, hospitality, and that sector continues to do well. I think low ticket discretionary consumption, consumer durables also is a space which should do well once the benefits of tax cuts start reaching the hands of the salaried middle class. So that is again a space which should see better times going ahead.
All right, so travel and tourism is the theme that you should be looking out for. But other than that, Varun, I also wanted to have your take on the two-wheeler auto space as well, because after seeing almost 50% correction coming in on stocks like Hero MotoCorp and Bajaj Auto, do you feel that the valuation comfort is now getting back into this particular space? Because I was just seeing that on a one-year forward basis, stocks like Hero MotoCorp trading at just 15 times, Bajaj Auto 21 times, and well, of course, that premium is still there for Eicher Motors at 26 times. But give us some sense that what are you making of the two-wheeler auto space?
I think the auto space continues to be in the midst of a big disruption. As we move from ICE to electric vehicles, there will be some winners and losers. Our preference from auto space continues to be on the tractor side. I think that somewhere clearly we are seeing signs of a cyclical recovery. While last year was tough, we believe this year should be fairly good for the agri sector, and the tractor as a space should do well. I think also SUV players continue to gain market share. What we've seen is that compact cars continue to lose market share and the SUVs continue to gain. So those players which are geared towards the SUV demand, both electric and ICE, should continue to do well. So that's where my preference would lie in the auto space.
Right, so within the autos, it's the tractor segment that is expected to do well, and SUV makers can continue to gain market share. Two-wheelers not looking that attractive. That's the word coming in from Varun. But other than that, what we see holding up is some of these stocks like Oberoi Realty as well as Godrej Properties, the Realty Pack like we discussed. But another stock that is popping up is BSE, of course. And Kunal, if you can help us with a chart check on this one, while of course we have been discussing the whole point in this recent correction that there has been a change in terms of the expiry days, and that could impact the volumes of BSE. But there's been no respite in the stock selling. I think it's the third consecutive week where the stock is feeling some pressure. Till what point do you believe this could persist?
Well, yes, the third consecutive week, and I think in the last 3 weeks, the stock has given up almost 40% or 30%, 35% of the gains for itself from 6,000 levels. It's fallen down to 3,800 mark. Now, my expectation was that maybe over the start of this week, the stock could probably have settled. Had the stock held on to that 4100, 4150 crucial support point. But the manner in which the stock had broken below this crucial support and fallen another 200 to 300 odd points further from those levels indicates that we could be at a zone where the stock may drift or underperform for some more time. Now, ideally, in such kind of a scenario, it is very important to try and look at the points where the stock the beta of the stock changes significantly. Those are the points which the stock has to cross back on the bounce back mode to try and come back into a recovery trend for itself. So I think in this case for BSE, that zone is around the 4,100 to 4,150 mark. I think till the time the stock trades below those levels, I would actually expect that the stock could underperform for some more time.
Varun, a final question to you. Whatever happens to the erstwhile defense and railway theme? I mean, as we speak, CG Power has got a 400 to 450 odd crore rupee order for Vande Bharat train sets. BEL has been seeing consistent order flow. They secured another set of orders worth about 843 crore rupees as of yesterday. The stocks, or rather these segments, sectors were the first ones where the first signs of, a sell-off in the mid and small caps actually came about. Do you think they're ripe enough now to start adding positions again? Or would you say that, that kind of heyday rally is not going to come back in railway and defense names anytime soon?
Data which has been coming out from December onwards, central government's capex has come back in a very strong manner, and our sense is that they will be very close to the revised estimates for FY25 and FY26. Also, we should see a good growth. So I think broadly, if you look at the direction for the next 3, 4, 5 years, we expect good capex. As far as the defense space is concerned, for the railways, I think the budget this year was largely the same as it was last year. Having said that, I think most of the stocks in the defense and the railways, especially the PSUs, had run up way ahead of fundamentals, and in some cases the multiples had been 70, 80, 100 times, and there has been a meaningful correction in some of these names, and some more could happen going forward. But selectively, I think the growth story is very much there, and one has to pick and choose the right names. Selectively, capex will continue to happen, be it power. I think power transmission distribution looks much more interesting. Select defense and railway stocks may also do well if bought at the right valuation.
Right, so that's the take on the railways and defense pack. With this, Varun, we'll let you go. Really appreciate you taking the time out and speaking with us this afternoon.
If you like this video, then like, share and subscribe to ET Now.